All right. So again, thank you all for joining us from wherever you are joining us today. As Professor Coleman mentioned, and as I mentioned, we do welcome you to turn your cameras on so we can see some faces. It makes the engagement a little more so. So I am very pleased to be joined for this masterclass by Thomas Coleman. He's a senior lecturer here at the University of Chicago Harris School of Public Policy. And broadly, his research focused on financial markets, which is fitting given the focus of this masterclass, blockchain, crypto, and strategy incorporated. Professor Coleman earned his PhD in economics here at the University of Chicago, and then he worked in the finance industry for more than 20 years, much of his experience in trading, risk management, and quantitative modeling. And then he returned to the university in 2012, first serving as executive director and senior advisor at the Becker Friedman Institute for Research in Economics, and then in 2015 as a lecturer here at Harris. I would like at this moment to turn over the introduction to Professor Coleman and Gina Washington, who is a MPP student here, to give a little more context about experience with Coleman in the classroom. And then I would also say, before I hand it off to my colleagues, that if you have any questions for Professor Coleman or for Gina as the presentation goes forward, please post it in the chat and I will bubble it up at a time when we have it. So I am turning the floor over to you, Professor Coleman and Gina.
Yeah, so thank you, Blake. Hi, everyone. Nice to see you all. I'm here to introduce Professor Coleman and kind of give more color on his background, perhaps, and how we became acquainted. But Professor Coleman, apart from being a professor, he also serves as the executive director of the Center of Economic Policy in U Chicago. He spent most of his time working in the financial markets outside of academia. He founded a London-based hedge fund, and also worked in SG Warburg in London, and that's something we both have in common. We both used to live in London. I took his class called Applied Financial Management. Amongst other classes, he also teaches history of financial crisis, a new class on inequality, and he's also in charge of the finance policy specialization. So for those of you who are thinking about taking the finance policy specialization, you'll be hearing a lot from him. But it's the class that I took, Applied Financial Management, is one of my favorite classes in Harris because it really just provides a practical understanding, but also with the theoretical understanding of finance for those who are an expert, or if you consider yourself an expert in finance, you can also think of it as just sharpening your toolbox. So it's both foundational, but also super enlightening, and you always learn something new about finance in that class. So that's how we got to know each other.
Good. Well, thank you, Gina. Thank you, Blake. Most of what they said is true. But I want to turn it to just before we turn to blockchain, and turn it back to Gina a little bit.
Yeah.
Because she's her experiences outside of the classroom, I think, are important. She's a member of or I think an editor of the Chicago Policy Review, has started up a podcast. And so if you can say a few words about your sort of experiences and opportunities outside of the classroom.
Thank you. So I'm a second year MPP student, and besides doing academia, I do a lot of work in extracurriculars. So one of the organizations I'm primarily involved in is the Chicago Policy Review, which is the student-run journal, and I'm editor-in-chief of that magazine. And you, as students, basically are able to, provide your commentary, submit your opinion pieces on any sort of policy issue you're interested in around the world. And I also have my own podcast where I interview Professor Coleman. It's called The Spin, so that's my shameless plug. But I work at the Polsky Center, and I work in the financial investment arm there. So there are a lot of opportunities here in Harris to go beyond academia.
Good. But let's turn to sort of an academic question. And so this is going to be a little bit like some of the classes that I teach, a topic that unfortunately I don't have time to cover in class. But talking about blockchain, crypto, I have up there MicroStrategy. We're not going to have time to talk about that today. But I want to talk about sort of solving some of the mystery around cryptocurrencies. Because this is really just a wonderful set of topics and ideas. And I probably don't need to tell you how current this is. But in 2008, this person, I think, Nakamoto Satoshi, published a paper called Bitcoin, a peer-to-peer electronic cash system, and coded the initial Bitcoin software. And this is still a wonderful paper to read. It's a little technical, but it's a really good paper. But it's also a mystery because nobody knows who Nakamoto Satoshi is or was. But whoever he or she is or was, they're rich. The Satoshi wallet has 1.1 million Bitcoin, and it hasn't been touched since 2010. So a couple days ago, that was worth about $77 billion. But nobody knows. This is a wonderful mystery. But that takes us to understanding some of the technology, or asking and wanting to understand some of the technology and the assets. And I want to separate the technology, which is the blockchain, from the assets, the Bitcoin, Ethereum, the tokens, stablecoins, other sorts of assets. Blockchain is the technology that underlies all of these crypto assets, Bitcoin, Ether, Tether, etc. It's the databases that record the ownership and the transactions in the crypto assets. The assets, now these are often coins, tokens, either Bitcoin, Ether. It can be other assets. Oftentimes are other assets. A former colleague of mine, for example, is working on factoring, a very old type of trade receivables financing, working on it in Italy, more recently moved to London. And sort of the third topic, and we're not going to have time, I think, to get to that today, is thinking about valuation. Why do you pay for something? Why do you pay $1,000 for a MacBook Air? Why do you pay $5 for coffee? Why do you pay $480? This is, a fundamental set of ideas in economics, and it's one of the things that we teach in our Micro 1 class. But all of these issues go together. Okay, the technology, the computer science behind blockchain and technology, the cryptography behind that, the assets, what are the financial assets, and then the economic theory of the valuation. And I do really think that what we cover at Harris in terms of combining the quantitative, the practical is really valuable. In any case, the outline, talk about blockchain, then turn to some questions and answers. I don't think we're going to have time to get through 3 and 4, which is a really interesting set of issues. Thinking about what is money, and then MicroStrategy, the biggest corporate holder of Bitcoin. Gene and I have actually been talking about doing something for the Chicago Policy Review on that. But let's turn to blockchain. What is blockchain? It's a multi-user database with concurrency. What does that mean? Well, multi-user databases with concurrencies are just crucial. They're a central part of any and all financial transactions, because all financial transactions involve databases. Whether you're buying online, whether you're putting money in your bank, whether you're paying a bill, these all require a database to record the transaction and to document the ownership. Standard databases are private. They're owned by the company. For example, your bank. It's got a database. It's run on their servers. There's many users. A bank, or think about Visa transactions, MasterCard transactions, thousands of transactions per second, possibly. So there's many users. The bank customers are using an app to deposit or withdraw money. And this issue of concurrency, handling requests from multiple users that come in at the same time, it's crucial to manage these multiple updates to the same account, putting them in order, resolving conflicts when 2 updates come in for the same account at the same time. And this is just an issue, a topic, part of computer science, part of database. It's just absolutely crucial to any financial transactions. Databases are central to all financial transactions. And if we were in person, if we were in a classroom, I would ask how many people kind of have worked or taken courses on database design, database structure, etc. So blockchain. Blockchain is kind of revolutionary because it's a public multi-user database with concurrency. So up until Satoshi Nakamoto, all multi-user databases were private. The bank or the finance company completely controlled the database. They imposed stringent security so that outsiders could not hack in and change the database entries, right? Because, I mean, I would love to suddenly have an extra $1 million in my bank account, but, right, bank doesn't want that to happen. So you've got to have control not only on concurrency, but also security. But Nakamoto Satoshi, he proposed a really cool way to have a public database with multiple users, strict security, and concurrency. Nobody owns the database. Nobody enforces security. And it seems like magic, but it works. So how does it work? I'm going to try to give an overview of how it works. There's a lot of cryptographic and computer science details here. I'm going to try to gloss over those details. So blockchain, the original blockchain developed for Bitcoin, and we'll talk about some differences in a moment, some newer developments. But blockchain uses something called majority consensus and proof of work. So there's a collection of nodes, computers, individual computers, each of which has a copy of the distributed database. Okay, so there is no central repository. It's distributed. Everybody has a copy of it. A new transaction record, or a collection of records, a block, can be proposed by the node that first completes a difficult puzzle. This is some mathematical problem which is incredibly difficult to solve, but very, very easy to verify. If you come to me and say, I've solved this problem, I can almost instantaneously verify, yes, you've come up with the right solution. But coming up with that solution takes a huge amount of computing power. And solving this puzzle is what's called Bitcoin mining. But right, to solve this puzzle, you need to spend a whole bunch of computer resources, which means you've got to pay for a lot of electricity. And the money that you spend to solve this problem means that only serious nodes, only people who actually invest a fair amount of money will actually participate and be able to propose a new transaction record. This is the proof of work. Okay, it's a proof easily verifiable by anybody in the network that, if you come and propose this new thing and say, I've solved the problem, people can easily say, yes, you've solved the problem, and therefore you must have spent a lot of money to do this. And that's what's called mining, Bitcoin mining. So a new transaction is only added to the existing database if a majority agrees that it is a valid record. And a miner, somebody trying to propose, they're not going to propose a false record because it'd get voted down. Okay, so a miner is only going to propose a record if they're confident, that it's correct and going to be voted on by the majority. And as a reward, the proposer, the miner, is given some of this thing called a Bitcoin. And they're given 3.125 Bitcoin per mining at the beginning of 2026. And that was worth, a couple days ago, about $217,000. Okay, so then the whole process starts again, and about every 10 minutes, a new block is proposed because it takes about 10 minutes to solve this problem. Okay, now to go back and change, in other words, so what is hacking? Hacking, if you go in and hack a database, you're going and changing the records. Okay, now how can you go and change the records on this public database? Well, you would have to get everybody's agreement that the record you're proposing is correct. And people aren't going to vote on that, right? Unless it's I don't know how to explain it. This is kind of the magic part, but nobody's going to be able to hack it because nobody is going to be able to have the enough computing power to solve all of these problems quickly enough to go back and say, oh, I want to change this previous, and getting everybody to agree that yes, you solved all of these problems. Okay. So it's this proof of work, the fact that you have to spend all of this time and money to propose a new record, which is the way that it's kind of enforced that people can't go back and change the previous records, which means that people can't go in and hack it. So I don't know, Gina and Blake, are there any questions? Do you have any questions, or are there any questions from the audience?
We do have a question from Anna. The question
Okay.
is, how much does each block cost relative to the reward per block? And added presumably less than the reward, but by how much? And has it changed much
Well,
over
so
time?
Anna, what you're asking is what's the profit? And you know what? I got this question yesterday and I forgot. But Anna, I can't do it now. Although Gina, maybe you can, or Anna. Um, get on Google and Google Bitcoin mining profitability. There are websites which will show you um, based on your hash rate. The hash rate is a measure of how powerful your computer or your chips are. So based on your hash rate, based on your cost of electricity,
Mhm.
and based on the current Bitcoin price, but of course they can just get the Bitcoin price from live in the market. There, you see, right? And it shows you the profit per hour, per day, per week, per month, right?
Mhm.
And the whole point is, if the Bitcoin price is high, then that's going to mean for, every time you solve this problem, if you're the first one to solve it, you get 3 Bitcoin, you get $217,000. And if your price of electricity is low enough, it only costs you, $180,000 in electricity,
Good margin.
and then you get a profit. Okay, but what happens if the price of Bitcoin goes down? Well, the reward you get goes down, but your electricity price is still there. And so, right, the reward you get goes down, your costs stay the same. You're going to stop mining.
Mm.
Okay, so this is the economics of mining.
Mhm.
Um, okay. Um, Blockchain, I think, has the potential, I think it does, has the potential to revolutionize finance because it can possibly make financial transactions more transparent, safer, because the public blockchains keep track of all the transactions, can be viewed by anyone.
Mm.
Okay. And, it means the transactions, okay, if, let me ask you, you come from out of the US, and how, right, transferring money internationally
So difficult and
is,
costly.
it's, uh, the banking system is in many respects so inefficient.
Mm.
And here, if you have something with a blockchain, you just do a transaction and it's pretty much immediate, right? So it really does have the potential to revolutionize finance. But there's many, many issues. And again, I want to emphasize and just reinforce this idea of separating the technology of blockchain and the assets that sit on it. So Bitcoin has its particular blockchain. It has its particular database. Ethereum has a different blockchain. Okay. But the blockchain that underlies Bitcoin is terribly slow. It's like every 10 minutes, a new set of transactions. It's few transactions per second. They cannot process in the Bitcoin blockchain the thousands of transactions per second that are required for a credit card or other transactions. Okay, another problem, and this is something that's been highlighted many times, it uses huge amounts of electricity for this proof of work, right? These miners are out there trying to solve this problem, and the more miners you have, the more electricity it uses. It's terribly wasteful. So there's many proposals to solve these problems. There's something called proof of stake. So instead of spending the money on electricity to prove that you've actually done the work, um, and this is now used in the Ethereum blockchain, um, people put up money that's tied into the blockchain to verify their integrity, to ensure other people that they can trust them. If they misbehave, their money gets taken from them. So there's a strong incentive to behave and be honest. And it's so the idea is, and this is what Satoshi Nakamoto came up with, was a way to provide trust, even though you don't know that necessarily the identity, you don't know anything about somebody, but you can trust somebody in the Bitcoin blockchain because they've done all this work. They've spent money. You can say they're serious. In the proof of stake, you can trust somebody because they have put this money up, and if they misbehave, their money disappears, their capital disappears. Now, there's various solutions for scalability. There's sharding, where you split off into sort of sub blockchains. There's layering. There's use of smart contracts. And so I was talking about this yesterday with a former colleague, a former student, who now works at the Federal Reserve on some of these issues. And she reminded me there's a whole bunch of jargon associated with the blockchain and Bitcoin. I've tried to avoid a lot of this jargon, but some of the challenge you're going to have if you want to understand and think about blockchain and Bitcoin and all that is all of the technology. People try to blind you with their technology. Don't get misled. Some of these ideas are, they're deep ideas, but don't get misled by the words. Okay.
Actually, Professor Coleman, I
Yes.
had a question come through from
Okay.
Andrew,
Okay.
asking, we talk about don't get misled by things. He asks, do you see blockchain as realistically competing with fiat currencies, or mostly functioning alongside them?
So Blake, let's see. We have another 3 hours for this presentation. Is that right? No. But I'm serious. So let me just go. That's what I wanted, and I don't think we'll have time. Although maybe we'll be able to just
answer briefly, maybe.
Yeah, maybe I can. It drives me crazy because people talk about Bitcoin and Ether. They're given the name cryptocurrencies. And that is so misleading because it makes people think that they are somehow currencies. They're not currencies, they're assets. Okay. And we want to think about what is money. Okay. And once we understand more clearly what is money, then we can ask and go think about, are these things currencies? Are they, could they replace fiat currencies? And my answer is no. So let's just you know what, I'm gonna violate one of the basic precepts, which is to keep to the schedule. But let me just jump a little bit to this question, because I think it comes down to asking what is money. Okay. And money, I think we want to think about money not in terms of what it is, right? Traditionally, people think of, okay, money was gold back in the 1800s. Money was banknotes, these pieces of things. I don't know why I carry them around still, but bank checking accounts. But we want to move away from that. We want to think about, what do we use money for? Money acts as a medium of exchange for transactions. Okay. Let me ask, does Bitcoin or Ethereum, can it be used as a medium of exchange?
Yeah.
Yeah. That's one of the beautiful things about it. Okay. So in terms of this kind of component of money, yeah, it can satisfy that. Okay. Store of value. What do we mean by that? I think we mean by that, and these paper notes are kind of good for that, right? If you give me this, I can put it in my wallet. Yeah, I can put this in my wallet. and come back a week or two later. It's as long as I don't lose my wallet, it's still there. I can store this value in my wallet. Does Bitcoin do that? It does pretty well because, right, the blockchain records my ownership, and that ownership gets recorded, and it's stable. It stays there. Everybody can see it, right? It's not going to disappear. As opposed to something like a block of ice. Block of ice would be horrible for money because it just melts away.
Right.
But then there's this third thing, and this is a little bit mysterious. Acting as the unit of account. And this is thinking about what is the price of money. And this is, so you didn't take the history of financial crisis.
No,
okay.
not yet.
So this is one of the things we cover in the history of financial crises, because this is the fundamental question about money and inflation. And I struggled for years as a graduate student to understand what this means. But I think it's really thinking about what is the price of money. And so let's see, how are we doing on time? We're doing okay. And we'll come back to the questions. And if we cut that short, I think this might actually be useful. So let me ask you, let's see, I don't have a $5 bill, but let me just pull out. Okay, I have a cup of coffee here. Let's say that you have that cup of coffee. Okay. And I ask you, what's the price of that cup of coffee? You say $5. Okay. And so I want to buy that cup of coffee. I pull out, let's pretend this is a $5 bill. I pull out this $5 bill. I give you this $5 bill, and you give me the coffee. Okay. I bought the coffee by giving you a $5 bill. But we could easily turn that transaction around. And I could ask, you could ask, how much is this $5 bill? What's the price of this $5 bill? And my answer would be a cup of coffee. Okay. I'm going to charge you a cup of coffee to give you this $5 bill. Okay. That's right. Because normally we think about, what's the price of a cup of coffee? Oh, it's $5. But we can turn that around and we can ask, what's the price of $5?
A cup of coffee.
It's one cup of coffee.
Yeah.
The price of money is actually determined, it's set by how many things you can buy with it. Okay. And that's sort of this question of the unit of account and the price of money. The price of money is, how much do you have to pay in cups of coffee to buy a $5 bill? Think about like 30 years ago. How much was a cup of coffee 30 years ago? Maybe cost $1. Okay. So dollars were a lot cheaper back then, because one cup of coffee could get you,
less.
Yeah. Anyway.
Yes.
We always get, but this is the key thing. Okay. We denominate everything in terms of dollars. Coffee, computers, everything we denominate. We use these dollars as a unit of account. And that is the thing that we're not doing with Bitcoin or Ethereum or other things. It's possible we could, but I don't see that in any reasonable scenario for the next, I don't know how many. So I think that Bitcoin, Ethereum, medium of exchange, excellent. Store of value, excellent. But acting as a unit of account where we count everything in terms of the number of dollars, Bitcoin and
stablecoins now is pegged to the fiat currency.
But let's okay. So this is kind of the,
we're going on a tangent.
But we'll come back to that tangent in a minute. So that's kind of the
Actually, Professor Coleman,
yes.
a couple other questions tied to this. First, what is the difference from Christian? What is the difference between Bitcoin and wrapped Bitcoin? And then
That I don't know. You would have to
If I'm not mistaken, Rad Bitcoin is basically it's Bitcoin that's compatible to be traded on a different blockchain. So on an Ethereum
that would be
blockchain, and it's pegged to Ethereum, for example,
yeah,
or whatever blockchain else, so that it makes people who are
on the Ethereum blockchain.
Bitcoin holders able to transact on different blockchains.
That sounds right, because you see, blockchain is the native token of the Bitcoin blockchain. It's not native to the Ethereum blockchain, and so you would have to wrap it up somehow. Okay, that's probably another question.
The other question was from Leo asking, if blockchain is a decentralized asset, how can its decentralization be ensured once it enters an exchange for trading, such as Binance?
Because you're still all of your transactions are done on the Bitcoin blockchain. When you do a transaction, you're actually it's not on Binance's database. It's on the blockchain database. They may be enabling you to enter your transaction into the blockchain, into the Bitcoin blockchain, but all of those transactions are on the Bitcoin blockchain. So it really is a bit of a different exchange than, say, the New York Stock Exchange, where if you and I go and trade in the New York Stock Exchange, then that is, well, actually, it's kind of, I mean, let me ask the participants, do you know where all of the transactions on the New York Stock Exchange and the NASDAQ, where are those recorded? Anybody know? Probably not, because, right, who cares? It gets done. Okay? But it's in something called the DTCC, the Depository Trust and Clearing Corporation. They have a database. Everybody agrees that's the database that records all of the transactions on stocks in the US, stocks, bonds, etc. That's recorded on the database of the DTCC. Okay, so any exchange actually goes to the database of the DTCC. But with Bitcoin, the database, it's not as centralized, it's a decentralized, it's the Bitcoin blockchain. I don't know if that answers your question, but anyway. Okay, let's jump back up to our original so let's see. Yes. So there's many issues. There's proposals to solve these problems. These problems have not all been solved. But there's a lot of applications where people are using blockchain for recording transactions in a decentralized database. Let me say one of the best introductions to the technology of blockchain was a paper written by Jessica Kong and Cristina Martinez Cuellar, who are students here at Harris. And were students, right? Actually, among my very first students here at Harris. And this is the link to there. But if you Google Harris blockchain, you should come up with this. So, having said that, let me kind of open up. Gina and I were talking yesterday, and she came up with a bunch of questions. So let's kind of turn it.
Yeah, let's center the conversation a little bit about blockchain's application, and more so, we talked about the value proposition of blockchain, where it is, decentralized. It has all these core tenets of being transparent, and there are no intermediaries, no transaction costs. But when we think about, in practicality, do you think that it has delivered on its promises? And do you think that there are things that need to be improved drastically?
Well, yes, there are things that need to be improved drastically. And I think one of the things to recognize is that in any big technological change, it takes time for institutions, for peoples, for practices to adjust
Mm.
and to figure out how to do things. There's also technology. As I said, blockchain, the Bitcoin blockchain, for example, is very slow, cannot handle a large number of transactions. People are working on solutions. Um, but there are solutions. A former colleague, a former partner and friend of mine is working on what was originally a solution for building or making more liquid and transparent the factoring market, which is short-term lending, among Italian firms,
Mm.
and using blockchain to record the transactions, using other cryptographic solutions for digital identity. And so I think those kind of solutions, but there's a lot of regulatory issues. If I mean, let me just highlight one of the issues. You or I do a transaction, say with our credit card,
Yeah.
and there is fraud involved or some problem, we can go back to the credit card company and they can reverse the transaction.
Yeah.
On the Bitcoin, or sorry, on a blockchain transaction, that transaction is done.
Yeah.
And there's no way to kind of undo it.
Well, there is. It's called forking.
No, but that's not undoing
undoing
an
it. It's just,
individual
yeah,
transaction.
that's right.
Yeah. So, we have to develop sort of some new ways of operating. So I think that it has not delivered on its promise, partly because it has the potential for changing a lot of the way we do things. And that takes time to work out the regulatory and the other issues. So I think the fact that it is still has a lot of things to deliver on is not a criticism. It's just part of the process of developing.
Yeah, so this is a really important topic because of the Genius Act that was passed last year, a bipartisan bill in Congress that basically addresses the issues of stablecoins and how, Bitcoins or cryptocurrencies in general are usually really volatile. So hence the name stablecoins. There's now a new crypto asset. How do they really work, and what's the difference between stablecoins and traditional finance?
Okay, so what is a stable coin? A stable coin, okay. Um, the idea of a stable coin is that it is a token. It's something which resides natively on a blockchain.
Yeah.
Okay. So, I mean, let's say I want to go and buy some Bitcoin. Okay. I mean, I can't just take my dollars and go and buy the Bitcoin. I have to somehow get this to be somehow on the blockchain.
Through platforms like Binance, like all
Well,
these.
yes, but okay, so I take my dollars and I go but what am I going to buy? What am I going to put on I could go and buy Bitcoin, okay? But that Bitcoin may go up and down. It's very volatile.
Right.
It would be nice to have something on the blockchain which was stable and traded one for one with a dollar. That's the idea of a stable coin. And so people develop these things and say, okay, we're going to make sure that this asset, this crypto asset, it's called a stable coin, but again, I don't like the idea of coin. I don't like the word coin, but it's an asset. And we're going to, let's say that Gina sets this up. Gina promises that it's going to be one for one with a dollar. And always, I'm going to put it in. I give a dollar, she gives me one of these things. And if I come back a week later, and she'll promise to give me back a dollar. Now, how could she make that promise credible? Okay, what would be a way that she could, because, right, I don't know if I'm going to trust her that a week later she's going to be able to pay me back. Well, what she could do is I give her this, so take it, okay? and you could go and buy, say, some treasury bills.
Yeah.
Okay. And those treasury bills, we're pretty confident that a week later, those treasury bills are still going to be there, still going to be worth and so if I then come back to you and I say I want my dollar back, you can then go take those treasury bills, sell them,
Yeah.
and you're going to be really confident that you have a dollar to give me back.
Yeah.
Okay. And think that's the way kind of banks work, right? Okay. Let me have my money back. You're right. If I give my money to a bank, the bank then at least takes some of that and puts it in reserves.
Yeah.
Something which is there that everybody has confidence that they'll be able to go back and get it later to give me my dollar back.
Yeah.
So that's one way to make a stable coin work. I don't know. Does that make sense to everybody?
There's some questions.
Yeah, I was going to say one of the questions that I feel there's two here. I want to go to Christian's first. It feels tied to what you're saying. Said you talked about the security of Bitcoin and not being hacked, but do you think in the future that quantum computing and AI power could actually manage to crack Bitcoin, and can it realistically happen?
Yeah, okay, so that's an excellent question. That's a bit of a diversion, but let's take that diversion.
Yeah.
Yes, but you know what? In terms of worry about security with quantum computers coming along, blockchain and Bitcoin is pretty low down on the list of things to worry about. Why is it low down? Because there's other things which are so much more serious. Everything in terms of the security, cryptography, sort of digital security within our digital world has real problems with quantum computing being able to solve some of these, what are under current technology, incredibly difficult problems to solve, become in some cases with quantum computers easy to solve. Okay. So yes, it's a problem for blockchain, but it is part of a much, much broader problem. People are working on this. There's potential solutions for security within the quantum computing world. It's not something that I'm an expert on, but I do have pretty good confidence that by the time quantum computers become really feasible and viable, we'll have solutions for cryptographic solutions. And it says cryptographic solutions are going to work for security across the digital environment, including blockchain.
Yeah. Yeah, that's a great answer. Yeah.
Yeah. Okay, so Blake.
Then second question there. Leo was following up on the decentralization idea he brought up earlier. He said, you mentioned that regardless of where Bitcoin is traded, the data remains on the blockchain database. However, if a core tenet of blockchain is decentralization and true self-sovereignty, the idea of becoming your own bank, does it lose its original essence once it enters centralized exchanges? And at that point, does it stop functioning as a decentralized cryptocurrency and instead morph into a new type of centralized financial?
Well, wait. I think there's a difference between centralized exchanges where people get together to trade things. I mean, I need to think about that a little bit more, but there's a difference between the database where things are recorded versus the exchanges where people, because I'm going to go a little bit out on a limb, but I'm pretty sure this is correct. Right? I can go and set up as a Bitcoin miner. In fact, back when I first came to Harris,
Yeah.
I had a student who was mining.
Right.
Okay. Now, I can set that up on my laptop. Am I ever going to win any Bitcoin? No, because my laptop, the computational power that has been applied to mining Bitcoin and solving this problem is huge. Okay. But my understanding is that I can go and set up on my laptop, and I can write into the blockchain directly. I don't think I need to go to an exchange. It's much easier for me to go to an exchange and have them do the transaction on my behalf. but my understanding is I don't need to do that. I'm not, I mean, I'm not going to set it up on my own laptop because it's too much of a hassle.
Mm.
But I think, I mean, unless somebody corrects me, I don't think I need to go through one of those exchanges. It's just it's much easier for me to go through the exchange. Another thing, sorry, I just should mention with respect to hacking, um, the blockchain, whether it's Bitcoin, Ethereum, or any other blockchain, is effectively non-hackable. I mean, it's theoretically, but it would be almost impossible as a practical matter. But we hear all the time about hacking within Bitcoin, but that is the hacking of the wallets or the exchange, primarily of wallets, people having their passkeys or other credentials for access to their wallets being hacked. That's a very, very different issue than the blockchain itself being hacked. And so there's a lot of hacking within the kind of crypto world, but that's not hacking of the blockchain itself.
And then two questions about stablecoin.
Yes.
First, from Andrew, if stablecoins become widely used for transactions, how would traditional reserve requirements work? Would that weaken central banks' control over money supply?
Well, okay, let's think about reserve requirements. Reserve requirements are essentially kind of not really relevant today. In 2008, in 2007, reserves, I should know the number, and I have a picture, but I can't bring it up quickly. But reserves were tiny in the US. What happened? Anybody know what happened in 2008?
Let me think.
There was a little bit of a financial crisis.
Just a little.
And one of the things that the Federal Reserve and the banks did was increased bank reserves, not by a little bit, but by like a factor of 10. Okay? And so at the moment, currently, bank reserve requirements are totally irrelevant because banks hold so much reserves relative to what they're required.
Mm.
It's just so I think this issue of reserve requirements is kind of people think about it, but it's a holdover from 20, 30 years ago. I don't think it's really relevant today. So yeah, I don't know, but sorry, Blake, or was it Andrew? Do you want to ask that question again after I've kind of criticized reserve requirements?
Well, Andrew, I got perfect thank you in the chat, but well, if that does come again, I want to share Raphael's question, which is since decentralized blockchains pay for security by, quote, printing new tokens as mining rewards, does that extra supply naturally push the price down? If so, how can a stable coin maintain a $1 peg while still issuing rewards to the people running the network?
No. Okay, so a couple of different issues. Bitcoin, the original protocol set up by Satoshi Nakamoto, limits the amount of Bitcoin and the reward of Bitcoin. So let's just flip up a bit. I said the reward was 3.125 as of 2026. This changes and goes down over time. It was built into the original and it's still there, limiting the amount of Bitcoin. So yes, the amount of the quantity of Bitcoin increases, but it increases at a slowing rate, and it's capped at a certain amount if ultimately, because this keeps going down. Okay, so that's the one issue. The second issue is that let's see. So there's two sources of rewards. The only reward I've talked about here is the miners receiving some Bitcoin. Okay, but there is a second reward, which is a fraction of the fees that people pay for using the blockchain, the Bitcoin blockchain. Now, it turns out that the fees that people pay for using the Bitcoin blockchain are very low. And so as a fraction of the reward, most of the reward is the Bitcoin that people get paid. But I believe on the stable coin, well, okay, Tether. Tether is the biggest uh, the biggest stable coin. What's the reward to the people who run Tether? Can anybody think of what's the reward that the owners of Tether get? Okay, Gina, you're running a stable coin. Okay, I give you $1. Okay, you take that dollar, you go out and buy treasury bills.
Okay.
Okay, now treasury bills actually pay interest. Who gets to keep that interest?
Me.
You do.
Yeah.
That is a huge source of revenue. Tether gets a huge amount of money. And so their reward is not because they get extra tokens upon producing. No, their reward is that they earn the interest on the the money that the dollars that they take in. So I don't know. Does that answer? I think this issue of stable coins is just a really an interesting and important issue.
Yeah.
Does that, Blake, does that answer the
We
question?
have 4 minutes left.
Yeah. Oh, we have 4. Oh dear. Okay. So I don't know, maybe let's
I think maybe this question.
for students interested in digital assets, where should they focus attention and skill development? I kind of wish I had a better answer for this. And really we should have talked about this more yesterday.
Can I offer my
absolutely.
insights? So I'm quite bullish on blockchain and crypto, and I've only ever no, I encountered it. It was really stigmatized during COVID because of tokenizations and like
Yeah.
all the ape NFTs, whatever. But with stable coins, I think it's getting very, very popular and the use cases are really rampant. So one thing I did, because I'm really interested in this area, is take classes actually besides the foundational classes like applied financial management and corporate finance, which are offered in Harris, is also to take classes outside of Harris that pertain to digital assets. So one class that I'm taking right now is called Blockchain, Cryptocurrency, and the Law. Which is a seminar-based class in the law school, and you basically read things like the Genius Act, you read things like the Clarity Act. You have to have the ability, I think, in terms of to answer the skill development part, to change your mental model quickly because things are evolving so much technically and also from a regulatory standpoint. So that's, I think one way to think about it is to actually continuously read the news and focus your attention on things like the Clarity Act, the Genius Act. The Trump administration is super bullish on crypto as well. So
yeah, and I would also look at regulation and regulation in the U.S. versus Britain versus Europe, and some of the differences in the approach that regulators are taking is I think really interesting set of ideas. Let me push back a little bit though, or not push back in terms of bullish on blockchain, because I think again, it's really important to distinguish between the blockchain, which is a technology for decentralized database, versus the assets.
Yeah.
Because I'm just hugely, I don't know whether bullish is the right word, but boy, blockchain technology is something that has the opportunity to transform finance.
Absolutely.
But boy, some of these things that are out there.
So many things, operations, outside of finance, so many things.
But some of these assets, Tether, I mean, don't get me started on Tether because, right, Tether, they don't even audit. They don't even have regular quarterly or annual audits. I just, it's beyond me why anybody would put their money into that kind of non-transparent, and go back to FTX, the one that blew up a few years ago, right? There in the customer agreements, there was no segregation of assets. This is very, very basic stuff in finance and regulation. And as an investor, I just would be incredibly careful on some of these things like Tether, like FTX, simply because I'm not sure that I trust some of the way these things are managed. Anyway, that's a closing thought.
Professor Coleman, want to get, and again, we are being mindful of everybody's time here as well, and thank you all for joining us today. I did want to put out this perhaps final question from Jessica, which I appreciate because it goes back to the top of the conversation, and it's a good high-level question. I think and the question is, how is the value of 217,000 assigned to the Bitcoin? The complex problem is solved, but where does the money value come from?
Where does the money value come from? Well, there's something called supply and demand. And it's something we cover in Microborn. And that's all it is. You know, what's the supply of it from the miners? How much does it cost to produce? And what's the demand for it? And that's
driven by willingness to pay.
It's driven by willingness to pay. I mean, there's a whole bunch of issues that was sort of talking about with respect to why is something valuable. We're not going to have time to talk about that, but I think it's a really, one answer is it's simply supply and demand. How much are people willing to pay for it? But there is another side to it, which is why do you pay for any financial asset? Well, you pay for a financial asset because you're going to get cash back in the future. What cash do you get from Bitcoin? I'll just leave that as the question.
The lingering final word, yeah.
Yeah. Okay. Thank you.
All right. Again, thank you everybody for joining us today. I mentioned it at the top, and I shared it in the chat. This presentation will be available. It will be sent to all attendees, all registrants technically, probably about 48 hours. It just depends on how quick it takes Zoom to process information for everything. Thank you again, Professor Coleman. Thank you, Gina, for joining us this morning in Chicago, I should say. Don't be so presumptuous.
Yeah.
And I put a couple of links for administrative admission stuff in the chat as well. Hope to see you at future upcoming events. Hope to potentially see you at Harris in the fall. Thank you again for joining us, taking time today. For everybody, take care and have a good rest of the day, wherever you might be.
Thank you, Mike. Thank you, everyone.
Okay. Bye.